Hi everyone, Billy here from iTradingU. Today I'm going to cover one of the things that I get asked quite a bit, quite often with new investors or new traders when they start looking at options. They ask two very important questions. This is going to be a two-part series, so we'll cover one of the questions today, and the next question will be covered in one of our upcoming sessions later this week, so be sure to check back on those. The two frequently asked questions are the following. Which strike do I choose when I want to buy an option? And the second question is, why do I use options in the first place? Why don't I just buy the shares outright? So let's look at this a little bit in more detail. Which strike do you choose? So firstly, you'll probably end up looking at the charts. Here I've got a graph of 3M. As you can see here, these little circles all represents the lows of a particular trend. So you can see every time we've made a low, it's made a higher low than the previous ones. This is typically a characteristic of an upward trend. But also you will note there that where the blue line is, this has been the high for quite some time now. And we flirted with that high, and from here it broke a little bit lower. So one could easily ask yourself, do you think this share price is going to continue to go on this trend? And if so, it'll probably continue for quite some time still. Alternatively, you can wonder what happens perhaps if this was the top of the trend, and from here the share price will just go lower again. Now today's discussion is not going to go around which directional play you want to do. At this point, you could probably consider using an option to express that view. So now we would look at this and say, well, which strike rate do we choose? In order to understand which strike rate to choose, it is important to understand how options react to time. So let's look at an example. Let's assume you're assigned a task to read 1,000 pages of a very, very big book over the coming 3 months. The first question you'll probably ask is, what is the probability of achieving this? So let's break it down in smaller steps. If we have 1,000 pages and we have 3 months to read it, there's 30 days per month. On average, we need to read about 11 or 12 pages a day. If we can continue at that trend, we'll hit our target. So now let's look at this. Over the coming 3 months, let's assume every day we manage to read our 11 pages. Can you see that at the end of the 3 months, we would have hit our target and we would have read 1,000 pages? Let's look at another example. What if in day 1 you read 15 pages and the next day you read 17 pages? Would it be alright to at this point already assume that you are going to hit your target? The correct answer is no, because in theory those are the first 2 days of a whole 3-month stretch, so we don't know really what's going to happen. And because these events happened at the beginning of the period, can you see that the effects of this is fairly subdued relative or in relation to the whole 3-month period? So it's going to take us a little bit more data points to figure out whether or not you're going to hit your target. But overall, we managed to read 1,000 pages. Now let's look at the following. We know that our target pages is 11 a day. What if on day 1 we met the target, day 2 we met the target, but day 3 we fall very, very far short? So for every day that we haven't met our target, it becomes exponentially more difficult to reach our target, because not only do we have to read the 11 pages that we should, but we also now have to make up for the pages that we haven't read. So can you see at some point we're going to hit a point in time where we realize from this point forward there almost is no chance of us hitting our deadline. Now options work in a very similar fashion to this. Let me show you what I mean. Let's assume we look at our graph here and I ask you, what is the chances that over the next 3 months that spot price of 3M will drop all the way down to where that little star is? If I look at this, given that we have 3 months to move, I would say that this movement is somewhat likely because nobody knows where we're going to go and we have enough time to get it there, so the probability is reasonably sound. Let me ask you this, what if we change the 3-month horizon to a 1-week horizon? What do you think now is the chances of 3M moving from 143 all the way down to 132 in 1 week? Can you see that at this point it is highly unlikely? So, in summary then, strike levels of options play a very, very similar role to what I've just explained. If you choose an option strike that is very, very close to the market and a lot of time, you buy a lot of probability for this thing to move. However, for every day that it doesn't move, it loses value. And especially at the end of time, when we have, say, 1 month to go, you'll see the exponential drop off in time value is very, very severe. However, you can fix that by buying deep in the money options, because now what you've done is you've created a situation which much more closely resembles the actual underlying shares. In this case, because we're starting so far in the money, the likelihood of our option being exercised becomes greater. And as such, the time that you lose, we call it time decay, is at a far friendlier slope than the one below it, where at the end of time, it drops off the cliff very, very quickly. In our next post, we will cover the answer to the second question, which was, why not just buy the underlying shares outright? Thank you very much for your time. I hope you enjoyed the session. This is Billy from iTradingU.